Good morning, everyone, and welcome to our newest edition of Let's Talk About It. My name is Haleh Moddasser, and I'm joined today by PJ Williams and Glenn Joyce. They share the role of Chief Investment Officer at Stearns, and it's not like we don't have a lot to talk about this week. So between the debate that we saw, surges in the virus, and unfortunately the news that the president and the first lady and Hope Hicks have all been diagnosed positive for the COVID virus. Um, we're expecting to see a lot of volatility here going forward. So, Glenn, why don't you, if you would, please put this all into context historically and tell us where we are with the markets year to date.
Thanks, Holly. Yeah, we'll look at what's happening year to date. If we'll go to the next slide, please. And so what we're looking at here are asset class returns. And I would say let's focus on the third column from the right that has year to date. So as Holly mentioned, it's been a very eventful 2020, as we all know, one we will not forget anytime soon, probably for the rest of our lives. And I think if you want to think about just kind of what's transpired, let's look at that third column from the right, year to date. And it's interesting that really only three asset classes have positive returns through roughly 3/4 of the year. I think this is from September 29th, so we're missing one day, but basically 3/4 of the year, bonds or fixed income have produced a 7% return, followed closely by U.S. large cap stocks or the S&P 500 at just less than 5%. And then of course, cash is a third asset just above par. The interesting thing is the rest of the asset classes are negative. And so diversification really hasn't worked as well as we normally would like for it to. You can notice that by the asset allocation portfolio, that white block, fourth from the top, that represents about 55% stocks, about 35% bonds, and the other 10% is made up of commodities and also real assets. So as you can see, as you go down that column, whether it's high yield, emerging markets, international, developed market, international stocks, small cap, real estate, commodities, they really haven't carried their weight. And so going forward, we do think diversification is something we still want to lean into, especially over the longer haul. We feel like it's not just about the returns, it's about the risk mitigation. And I think we definitely need to see some of these other asset classes kind of carry their weight as we go forward. And we expect over the longer haul, they will. If you think about, we'll get more into stocks and bonds a little bit later in the presentation, but I think basically with the low yields on the bonds and with U.S. stocks, or at least certain parts of the U.S. stock market being a little bit elevated, or at least valuation starting to rise, other areas of the market are starting to look a little more attractive. And I think those are areas that we do expect to produce as we go forward. And so while the lack of breadth is a little bit of a concern, we think going forward, we want to see some of these other asset classes start to move forward and show that they can carry part of the weight as well. And we think that will happen.
Great. Thank you, Glenn. As bad as all the news is, the asset allocation model is not looking too bad year to date, right? So it's I heard the expression recently that we have a K-shaped recovery. So this looks to be the truth, which is some asset classes and parts of the economy are doing well and other parts are just not, like the travel and leisure.
Yeah, that's right. It's definitely been a V-shaped recovery in the markets, at least among certain areas, and some areas that haven't recovered as much. And I think that's part of that uneven piece that you were just describing. So I think that's areas that we're actually looking at, in terms of areas that haven't bounced back, in areas that we think may represent some value, especially as some of these more socially dependent areas start coming more online, hopefully in the coming months.
Great, thanks for that. Well, let's go to the next slide and turn our attention a little bit on what the outlook looks like from an investment point of view, given all of the various factors that we have going on. So, PJ, I know we've got volatility is expected to be up. So there's several things going on. There's the election, there's the pandemic, there's the stimulus package, there's the social unrest. How does all of this play into our outlook at Stearns and how you're managing portfolios?
So I think we've talked about this before on these live chats. At SFG, what we're really thinking about is that the healthcare crisis coming to more clarity on where it's headed, whether that be with a vaccine or treatment as we go into the end of 2020 and early 2021, is going to drive kind of what we see on the economy. Short term, whether that be a month or two, you can see things happen where it might spike or decline based on an event or something. But really, when you're looking at what we're looking at on this chart is, okay, let's look 18 months out or more. What do we need to be focused on? And to us, it's where does the COVID crisis go? If we get it under control, or we get a vaccine, or we get a treatment plan, and we're able to continue to move forward in many states with reopening the economy, getting people back to restaurants, getting people back on airlines, we may see one of these, maybe not Goldman's forecast, we might see a positive forecast where we get back to where we were a little sooner than, again, if things, and you've seen it from Dr. Fauci and others who are very concerned with these next few months as we head into the winter months. If you look at number of positive cases per day in the U.S. at the beginning of September and at the end of September, they're almost identical, just over 40,000. So we didn't see any improvement. Where we did see improvement is the daily deaths. And so, again, that's where we've been focused, is hospitalizations and deaths, because that is really ultimately what I believe will drive the actions by your local mayors and governors in terms of policies they're putting in place. If they see a spike in those areas, you may see take a step back. We've seen that across the Atlantic. When you look at what's going on over in Europe, the UK especially has announced that they are going backwards in terms of their plans of reopening. Madrid in Spain has done the same. And so the question is, do we experience that here in the next few months? If that happens again, it might not look like Q2, but you will see a decline in economic output for this country just as a result of less interactions with businesses. And again, that'll be a strain on these small businesses and on the workers that are laid off. And we'll talk about employment here in a few slides. But just to focus quickly on this slide, you can see that as we went from Q1 to Q2, we had a sharp drop off. And then the question is, okay, where do we go from here? And what you see with the top line that never dropped, you're looking there at that light blue line, that was assuming that the healthcare crisis never came along, and we just kept clipping 2% growth. And you can see how we would look going into 2021. COVID did happen, so we had that sharp drop off. And then you look at, okay, Goldman Sachs is very positive in terms of they are forecasting across the broad economy more of a V-shaped recovery when they're showing that they think that we will get back to where we were pre-COVID, so end of Q1, by the end of this year or early 2021, and that we will catch up with the trajectory we were on by Q2 2021. You can see that on the other end of that, Deloitte and their forecast is more for kind of almost a double dip, a sharp rise in Q3 followed by another decline in Q4, driven by, again, probably slower economic growth or slowing economy from a outbreak of the healthcare crisis. So again, even on this chart going out to the end of 2021, Deloitte does not forecast that we will be back to where we were from an economic perspective with the U.S. economy at the beginning of 2020. And you can see that the median here of the poll is that it will take into the middle of 2021 before we get back to where we were, and that it'll be further out into 2022 or 2023 before we catch up with what the trajectory that we were on. So again, a lot's going to be happening, especially as you go through. We've already mentioned it. Holly mentioned it with the election, with the COVID crisis, and really where do we end up in early 2021 with the vaccine, with the treatment. That will kind of shape the next 6 to 12 months for this country.
Great. Well, not to put you on the spot, PJ, but that is kind of my job, right? How do you feel about the stimulus package kind of being held up right now? It's almost turned into a political football. And I read somewhere this morning that more and more businesses are permanently shutting down. So this is not furloughing or, it's going under. And so how does that affect things until we get to a vaccine or beyond COVID?
So really, when you're thinking about what you just talked about, it's really a question of what do you see in the underlying economy. Again, the stimulus package that was passed back in March and some additions made to extend unemployment benefits obviously significantly helped those that were temporarily laid off, those with lower incomes, to continue to pay their rent, to continue to buy necessities. You saw that expire, or much of it expired at the end of July. And so here we are, 2 months past that with no additional stimulus. We've heard from both Chairman Powell and other members of the Federal Reserve in recent weeks that really, they are looking for fiscal stimulus. They're looking for Congress to take action to continue to support the economy. Unfortunately, and again, I'll kind of preview what we're going to talk about in a few slides with jobs. This has not been a good week. There have been permanent layoffs across the airline industry, huge layoffs. You've seen it, announcements from some of the larger banks that they're beginning to lay off staff permanently. You saw Disney laid off 28,000. Again, their parks are not back open in California. And so the longer this goes on, you're going to see businesses continue to shut down, small businesses, and that's very, very sad and unfortunate for the owners of those businesses, but also their employees. And you're going to continue to see more and more talk of eviction concerns. People that are still furloughed or still laid off, even if it is temporary. Temporary is becoming a long time at this point. And how much longer can rent abatements be sustained, or how much is the government going to do to continue to provide for that? So again, we have a long way to go. You see the markets continue to rise when there's hope of a stimulus bill. You hear it talked about, whether it's with Nancy Pelosi or Mitch McConnell or Mnuchin. Whenever there's hope, you do see some positive reactions. The market's looking for that. But again, I think it's going to be necessary to find a bill of some type to support the areas that are most needed, and a lot of that does fall into small business. Holly, I'll just take one quick note here. We did have a question about the accuracy of Goldman. Economists notoriously struggle with forecasts, and so I don't want to put the Goldman outlook on a pedestal, or the Deloitte one is the right one. Again, we are probably at Stearns, we are in between these two. We are not forecasting a significant double dip, but we think the recovery will be slow and uneven. And on the next page, Glenn will touch on that.
Yes, and I would just add quickly to that comment that I think Goldman and J.P. Morgan were expecting a pretty strong snapback third quarter. But once again, it's a snapback. We had the worst downturn in the second quarter. I think on an annualized basis, it was like 32%. So the GDP number, once again, you don't necessarily annualize numbers that just happen inside of a quarter, but just thinking about the trend. And so, yeah, we're likely to see a pretty strong number that prints off in the third quarter in terms of an uptrend. But once again, like PJ described, things should then settle down. And once again, we're still not out of the woods, and there's still lots of things to consider as we go through the next few quarters.
Let's go on to the next slide.
All right, I'll go ahead and jump into this one. So this gets a little more kind of digging a little deeper here into what PJ was already covering. So, and to Holly's point earlier, we're talking about just how uneven this recovery's been. And so as we kind of look, there's a few things to focus on, but we're looking at different kind of industries or kind of sectors of the economy. And what we're looking at is just kind of how bad things were back in late March, but then how much we've recovered since then. And if you look at the legend, you can see some of these areas that are being highlighted. The first one, the top one, the mortgage application. So if you think about it, if you've been able to be fortunate enough to maintain your job during this and continue to kind of operate, as normal as possible in your work, you've probably maybe even saved some money on transportation costs, eating out, you name it. And there's been some advantages for some folks. And so mortgages is an area that if you've got the ability to capitalize on these lower interest rates that have come out of the Fed stimulus and all the things that have brought our interest rates down, we've definitely seen a surge in that sector of the economy in terms of mortgage applications and people looking to take advantage of low rates. And the good news on spending is you can see on consumer debt, credit transactions, we are worried about debt in general. We look across at our government situation, our financial strength, and obviously consumer debt's been a concern as well at times. But I think spending is something we are encouraged by in terms of that's 2/3 of our economic growth is spending, consumer spending. So those have been a little more upbeat in terms of the recovery, but then you start looking at some areas that are a little more tied to kind of getting out there and intermingling, kind of those socially dependent areas I mentioned earlier: hotels, travel, dining out, and then air traffic at the bottom. PJ already highlighted some of the struggles we've seen with Disney and with some of the airlines by cutting costs. Hopefully that will continue to improve as we continue to open up. But right now we're still, once again, struggling with the backdrop we're in. But the good news again is that things are continuing to open up, and as we'll talk about later, even though we're seeing maybe a little uptick in COVID cases, businesses are adapting and they're figuring out ways to kind of get through this. You don't want to underestimate the risk that we may have to take a step back. We have done that in certain states, but by and large, things are continuing to move forward, and I think that's what we hope in a safe manner.
Yeah, and to your point, Glenn, masking does work. And so people are assuming that you're socially distancing and masking and washing and that you can kind of open up on a limited basis in the economy. But you've got to do those things. I think the most recent estimate I heard was that 100,000 lives could be saved simply by masking. So that's probably the best weapon we have right now, even beyond a vaccine at this point.
It'll be interesting to see just some of the things that we adopt out of this environment, just hygiene, just simple things. And wearing a mask obviously is the big thing currently, but just all the things we're doing to protect ourselves now, it'll be interesting to see just kind of how much those continue, because I think we have learned some valuable tools. Yeah.
Yeah. All righty. So many companies are just barely getting by. And I heard this morning that something like 60% of companies, small businesses that are on Yelp are actually shutting down permanently. So talk to us a little bit about what this means going forward. Is this just part of the creative destruction of capitalism? New businesses will come eventually, or what does it mean for the workers and the companies?
Yeah, and so as we've already touched on today, the small businesses, maybe the mom and pop stores, are getting hit hard by the healthcare crisis, not being able to open up, and so you're seeing many shut down across the country. What we're looking at on this slide isn't even considering that. This is looking at companies in the Russell 3000 essentially. So think of the 3,000 largest companies in the U.S. by market cap. So again, that's the S&P 500 plus the next 2,500 or so in the mid cap and small cap space. You're looking at a number here that we're up to almost 15% are what are called zombie companies. And a zombie company essentially is a company whose earnings are only able to really get through its expenses and it's paying its interest expense. It's not able to pay down its debt. So it's kind of on the hamster wheel of just going around and around, not really being able to grow, but being able to just barely survive. So again, uptick in interest rates, which is not on the horizon, in our opinion, would be a serious issue for these companies. And this is something that Stearns was talking about last year and the year before. Many companies just being over leveraged coming into this. You can already see the number was up, north of 10% a few years ago. So this is not necessarily a COVID crisis event or the effect of COVID, but it is something that will not be aided, obviously, by COVID. And so again, the number being at a level equal to somewhere in the early 2000s is something to watch going forward. Again, this is not talking about companies that you think of when you think of strong balance sheets, Apple, Amazon, but it is newsworthy that 15% of our largest 3,000 companies in this country are barely getting by, every quarter of the year. And again, they a lot of it is a result of having too much debt, being over leveraged, and not being able to grow fast enough. So if the economy doesn't pick up, many of these companies will either continue on the hamster wheel and not grow, or they will be forced into bankruptcy. And we talked about on a previous live chat, the number of bankruptcies that have already occurred this year is definitely tracking with what you saw back during the financial crisis. It's definitely in certain sectors, not surprisingly, big box stores, retail are definitely experiencing the brunt of it. But again, it's something that we'll just continue to monitor. And again, it's something that Stearns, we really, when we're investing, we've been focused on quality, making sure that from a valuation perspective, things make sense to us. So we have been less in the smaller cap space in recent years as a result of just our expectation or outlook that many of these companies are already struggling. An economic crisis, a healthcare crisis like we're going through now, is only going to make things worse.
It's a sobering thought. How do you feel about the small cap space relative to the trade wars and everything going on?
I think it's going to be sector specific. Who is your end customer, and what does your supply chain look like? If you're all within if you're within inside the U.S. and your customers are the U.S., then you're going to go along with the U.S. economy. If things bounce back, you'll be in good shape. I think for small cap companies that have complex supply chains, and the larger companies are the ones that have the really complex supply chains. But if you have supply chains that are intermingling somewhere in Southeast Asia, whether that be China, Vietnam, or elsewhere, or even in Europe, and as we have ongoing trade discussions with various nations, depending on how those discussions turn out, you could definitely see another burden placed onto many of these companies.
Yeah, for sure. I thought am I getting
There.
There we go. All right. Well, let's talk about the elephant in the room, which is the election and everything that's going on. I'm sure many of our viewers watched the debate or tried to watch the debate. It was pretty painful to watch. So I think what this chart does is explain that it's really policy and not who is the president that impacts overall economy and markets. But why don't one of you take a crack at explaining this chart a little bit better?
I can lead off. You want me to, PJ, and then follow up? I would just start out with saying I think we probably do assign a little too much influence to the person in charge or the president, and so I think it is more about just thinking about policy and just about kind of what's happening hopefully with the Congress and as well as private businesses in terms of how they adapt and react to the policies. But obviously the big ones we keep hearing more and more about would be taxes and thinking about, what's the tax rate going to look like. And you look back at 2003, I think that was the Bush Job Growth and Tax Reconciliation Act. That was when they lowered introduced qualified dividends and lowered capital gains rates. And we've been, I think, pretty much in a lower tax environment really, for a while now. And I think at least from more of a preparation standpoint, we ought at least consider, maybe taxes are going to have to start drifting higher at some point. Obviously, we got to think about our finances and how we can best just improve our financial strength. Now, some of that could be just economic growth kind of reinvigorating, and hopefully that would be the denominator, right? You measure a lot of things on your GDP, your growth profile, and so if we can get economic growth to start improving, that would definitely make a lot of these numbers look a lot better. But I think from taxes, that's going to be something that we may have to address at some point down the road, regardless, whoever's in office. We'll just have to kind of see how that evolves. Infrastructure is something that I think we're all looking for. I think both sides, as you see on this chart, are feeling like we need to kind of continue to invest in our infrastructure. So we're really hoping that will materialize. Maybe we're seeing it more privately. I know in Greensboro here, we're seeing it more on the roads, especially around our city. So I think that's something that would definitely be invigorating for jobs. And then the other big one I might tackle would be trade. And we know China. There's a big competitive landscape now between China and the U.S. In terms that's probably going to continue, and there's probably going to be more conflict, I would imagine. Hopefully it'll be, as best it can be, I guess, but it's definitely going to be something where we're vying to be top dog, and I think that's probably going to continue, and I think we'll just see how that impacts, but I imagine both sides will adapt and we'll figure out ways to best navigate that. Maybe I'll pause and let PJ make a few comments, but I think I definitely agree with at least the premise that it's more about the policy versus the politics.
And I'll just add on to your trade comments and move to the chart on the right, where you're really looking at people that were surveyed, their opinion of China. And regardless of whether you lean Democrat, you lean Republican, you can see that the trajectory has been up and to the right the last couple of years here. A lot of that has to do with maybe the IP issues when you're looking at technology, when you're looking at the issues on trade. Cybersecurity is another big topic here when you're talking about our relationship with China. So again, this is something that is going to be an ongoing issue, and whoever's the next president is going to have to continue to navigate and negotiate with China, because again, it is the U.S. and China when you look at the largest economies in the world now, and it is a competition. And so again, we want to make sure that we stay on top of that competition to the best of our ability. Again, I think you can read what's on the left, but just touching on something that's obviously going to be discussed at the next few debates is going to be climate change. Again, where do we get our energy for the long term is going to be something that's going to continue to be discussed. And then the Federal Reserve, independence versus non-independence. You do want a Federal Reserve that is independent and making their actions not because of political affiliation, but because of what they believe is in the best interest of the U.S. economy. At the end of the day, with all this stuff on the left, it's going to be the outcome of the election to determine what policies can get enacted. Again, if there's a Democrat sweep, that looks very different than something that's got both red and blue in it. And so again, that's something that we won't know until we get into November as to what control one party may have to actually enact the platform policies that are on this page.
Yeah. So I think in the big picture, while we're hearing a lot of news surrounding, and it is unsettling to know that the president has coronavirus, and it is unsettling to watch the debates and feel how divided the country feels right now. But I think what we're saying here is, in the very big picture, that may create short-term volatility, but over the long term, it really isn't as impacted by which party is in power in terms of the economy and the markets. Is that a good summary, guys?
I think it is. I mean, again, if there's a significant policy change and there is a large increase in tax rates, that could have an impact. I think that the idea of creating economic growth, whatever policies are implemented, will affect it. When you look back over the long term, you have seen that the market's gone up under both types of administrations, whether that be Democrat or Republican.
Yeah. So we have a question on the screen. The viewer wants to know where they can get a list of those 15% top zombie companies.
Yeah, and we can follow up with that offline.
Okay. All right. Thanks. Well, let's go into the next slide, please. Well, this is a doozy. U.S. unemployment trends. I know that the jobs number came out today and it was significantly lower than expectation. Talk to us a little bit about what that means.
Yeah, I think as we were discussing, just with what we need to kind of continue to move the economy forward, that employment piece is very important because that does feed into consumer spending. And so we've had about 5 months now, I think, of positive job reports. If you remember our unemployment rate, and you kind of see this maybe on the left slide, shows you those blue bar charts, and you kind of see how high the unemployment rate got back in early April, about around 15% or so. And so you can see we definitely have declined quite a bit, and we're back down, I think, to 7.9%, I believe, is today's number. Like you mentioned, Holly, it wasn't quite as good. It was a strong number. I think we reclaimed like 660,000 jobs, and maybe they were expecting closer to 800,000 roughly. So it was disappointing in that regard, but it was still a strong month for September. The problem, as you see on this orange line, is that COVID is still out there, and it's starting maybe to trend up a little bit in terms of the daily cases. And so, we do want to just make sure that we continue to open up and do it, like you said earlier, in a safe manner. So that's still something that's clouding the picture in terms of some of these, third phases of the economy. This third phase trying to open up is, can it do it successfully, where we can have the restaurants more fully open up, the travel, just more the entertainment sector. Those are ones that are still out there that really are kind of not at full capacity or nowhere near. And so I think that's the big trend. But as I mentioned earlier, the adaptability of what we have opened up seems like businesses are finding a way. It gets back to the earlier slide, in that whatever the rules of the game are, businesses are very smart at figuring out how to capitalize, or at least to figure it out and do the best they can, wherever they have to work with. And so wherever cards are dealt, kind of the mantra there. So I think here, if you look, the one other concern will be if you flip over to the right side, here we're looking at more, you think about this being self-induced by the government because of obviously the coronavirus and the COVID-19 spread and how we had lockdown. And you can kind of just see here, we're looking at most jobs were felt to be temporary. And so you're looking at the blue line is showing you kind of the number of unemployed that were on temporary layoff and how that's come down significantly. But then now we're starting to see permanent job losses start to rise. And so now it's a concern about, we were at such a low unemployment rate historically back when we were below 4%. And now that we're back down to about 7.9, it may be a while before we get back to those historically low levels, just given some of these permanent job losses. And, once again, we could get back to economic trends sooner, but that's still going to be something we're going to have to reconcile is people that may not get back to work and figuring out how do we continue to support them and also continue to support the consumer spending that's needed for the economy. But overall, the trend's positive. We just have that one concern in terms of the permanent job losses and just making sure that we understand and can navigate what's going on with COVID. The other good news on COVID, before I forget that, is the fatality rate continues to stay relatively low, even though the daily number is upticking a little bit. So I think we'll just continue to hope for the best there. And I think this is obviously a key metric to continue to follow, the unemployment picture.
Yeah, good. One of the things to note is that while the jobs number is good, on an absolute basis, it's the rate of job growth is what has slowed down, which makes sense because the economy is kind of just not picking up, and with the stimulus package still out there and people losing jobs permanently, it's harder for people who permanently lost jobs to get back into employment. Their skills become more stale, the companies are out. So it does kind of portend a longer, slower recovery, I think.
Yeah, I agree.
All right, so we're at 32 minutes apparently. So let's try to zip through these next slides. When will a vaccine become available?
Yeah, so this is a great thought here. I mean, this is something everybody's been kind of trying to figure out. And so I think what's interesting here is how expectations have shifted some. We're starting at May and shifting over towards September. If you look at the bottom, the horizontal piece here on this graph. And so you can see, this is what we call kind of a soil chart. You can see how the percentages evolved back earlier in the year. People were thinking, by and large, there's a lot of people thinking this is going to be after. You look at that kind of tan segment at the very top, there was a lot of people thinking this is going to be after 2022, at least the first quarter of 2022. But notice how as you go kind of left to right, how the blue and the green sections, and the blue being by the first quarter of next year, 2021, and then the green being somewhere between the second quarter of 2021 and the third quarter of 2021. So we definitely have set expectations that we're going to have not only a vaccine available, but also have it being distributed to about 25 million people. Now, we have about 330 million in the U.S., that'd be less than 10% of the population, but still, I think that's the next thing, is not just getting the vaccine developed, but being able to have it available for folks. And so I think the news, at least on a relative basis, is getting more positive. And there's a lot of folks out there a lot of companies trying to make this possible. And there's definitely a lot in that third phase. And so I think it's somewhat promising, but obviously you want to make sure it's safe and that it's effective. And so we got to obviously get more data and see a little bit more. But so far, the trend seems to be in a good direction.
And so, Glenn, one of the things that I've been following is something like 52% of the public is wary of taking a vaccine. And so, even if you have a vaccine available, you've got to get to herd immunity. So you've got to have at least 40% of people taking the vaccine, with the idea that 20% of the population has somehow already been exposed, and that would get you to that 60% herd immunity. So we really need, as a country and as a government and the CDC and the FDA, we need to make sure that our citizens are confident that all the right protocols have been taken and that the vaccine actually is safe and effective. So that's a key component to, it's not enough for the vaccine to be available. People have to be willing to take it.
Yeah, that's a great point. Count my wife in the group that's very skeptical, and I'm not sure she would take it, but it's a variety of measures, like you say, whether it's just treatments, whether it's just living a healthy lifestyle and trying to be more preventative. And of course, as you get it, you have the herd immunity component you already mentioned. So it's a multi-pronged approach, but obviously each person's got to make that decision, and we all just want to get through this in the safest manner and the most effective manner possible.
Alrighty.
All right, this is an interesting chart. I'll go ahead and jump in, so we're kind of short on time, but this one is, I mentioned earlier about stock and bond valuations, and here what we're looking at is what we call an equity risk premium. So you think about that, that's really kind of comparing the earnings yield, or how much yield you're getting as an owner of a stock based on the price you're paying, versus the 10-year treasury yield, which we know that's been in the 0.2% range, like 65 to 68 basis points roughly. And so it's hard to think about, if you told us, 10 years ago, you're only going to get, 0.2% per year on a 10-year treasury, you'd be like, wow, that's nothing. That's like getting money market rates. And so, that's where we are. It's a sign of the times. And so when you think about stocks, yes, we've been saying that, especially in certain segments of the U.S. market, maybe in some of the growth sectors, we are starting to watch the valuations a little more closely because they have risen quite a bit on this rebound. But when you think about being in a low interest rate environment, you think about low interest rates, that makes companies much more profitable, right? Because they have low financing costs, they can borrow very cheaply. They can also, just discount their earnings and cash flows back at a very, very low rate, and that makes them even look more attractive from that discounting mechanism at such a low competitive rate. And then from an investor standpoint, you're sitting here saying, okay, do I want to get a very low yield? I might be kind of safe from volatility, or I can venture out and try to get a stock return. And so the equity risk premium, the big theme is here, are you being induced enough by the return expectations of a stock owner to go venture out and take risks versus being more comfortable or more conservative and more of a safe bond portfolio? And so as this line rises above the zero line, it's really saying it's more advantageous to take the risk and be an equity owner. But we all do know this is a very unusual time we're in, and there's lots of risk in terms of what we are highlighted. And so I think all this says is that you do have to at least think about the Fed and the stimulus they provided. It is usually a good environment for risk assets, particularly stocks. So we don't want to get too conservative, but at the same time, we want to recognize the risks that are out there that we've already highlighted.
All right, let's go on to the next slide.
On this slide, this is something that's been talked about a lot in Washington and across the country with investors. If you think back to even before COVID, the idea of modern monetary theory was brought up, MMT, by a lot. The idea that you really can just continue to print and print money, and it won't really have a negative effect until you get a lot of inflation. That's when you need to then rein in everything, is when you get to the inflation point. And there's a lot of controversy about that. And what we've seen so far is that coming through the crisis, we needed to have the stimulus, whether that be from the Fed or whether that be from Congress. We saw it. We've seen an uptick in inflation, but it's not a concerning level yet. And so the question is, going forward, is at what point and if do we get to that level where inflation does rise materially above what the Fed had been targeting at 2%. They just changed it last month to target an average rate of inflation, meaning they were willing to let inflation run above 2% before they took action to become to take on tighter monetary policy, maybe through the means of either letting their balance sheet run off or raising rates. And so the Fed definitely appears to be more concerned with deflation with their comments that have come out recently and what they've said they're going to do. But on this chart, and this will come as no surprise to anybody, that given the spending that's needed to go on and the spending that we have on an ongoing basis already, when you think about Social Security, Medicare, Medicaid, defense, we have some big ticket items that we're spending on, and our revenues from tax receipts mainly are not covering it. And so the deficit is relatively large, forecasted here at over 3 trillion. And again, that's something that will potentially be addressed with the next administration, whoever that is. But it's likely that we will continue to run a deficit for many years just based on where we're starting. And you can see on the bottom right, how does our current debt level compare to GDP look relative to history? And you can see the last time we were at these levels that we're at today was back right after World War II. We know there was obviously a lot of spending throughout that war to build out the necessary means to win the war eventually. So again, this is just something to continue to watch and to see how it's going to be addressed by all parties, whether it be Congress, whether it be the Federal Reserve. But the way we address it currently, the deficit, is that we just expand our borrowing each year through the issuance of more and more treasuries. And so on the last slide here, we're looking at who actually is, who owns the treasuries. And this is a recent analysis done by Bloomberg and the U.S. Treasury Department. And you can see that it's mostly owned by the U.S., whether that's individual U.S. investors or what we've seen lately with what went on earlier this year. The Federal Reserve's been expanding its ownership of treasuries. And so again, given the unique nature of the U.S. and the U.S. dollar and just where we currently are and how we're viewed, we are able to continue to borrow. And so we will be able to expand our debt via the issuance of treasuries without experiencing something that you might see in an emerging market country that can't issue its own debt like we can. So again, doesn't mean that we're not headed towards a problem, but the problem is not tomorrow in SFG's eyes. But it is a note that there's been lots of talk over the past few years about who owns our debt, what foreign governments own it. You can see here that the ownership by foreign governments is relatively low, and it has been declining for many of them in recent years.
Well, that is encouraging. Thank you for that. Was that our last slide? All righty. Sorry to keep you guys over, but I think we better call it a wrap. Thanks everyone for joining us today.